Hi, my name is Joe Perfetti. I'm a professor of finance, and I teach equity analysis at the University of Maryland, College Park. And today, I'm going to the flip chart to talk about the Standard & Poor's 500 index, which is near its all-time high, why it went up by 1.4%, and what are some of its drivers. Today, you can see a graphical representation of the S&P. This represents green, showing all of the sectors that went up. Red are the sectors that went down. Overall performance of the market, all green. Basically, the market went up with the one exception of financials. So the S&P 500 is an index of 500 of the largest companies across all industries that are just basically added up and weighted based on size. So if we look at all of the value of all of those companies and you add it up, you get an overall value of about 3380. And today it went up about 1.4%. So the question then becomes, how do we determine what the price of the index is, and how does it change over time? Well, that's where Wall Street comes in. So one of the things that's going to happen is that Wall Street is going to forecast earnings, which are a proxy for the cash flows. And this is a historical view of Wall Street's forecast for earnings that is graphed out. But the general idea is with these four lines, this bottom line, which is the actual line, represents the actual reported earnings for the last 12 months, generally quarter by quarter, for all of the companies added up, the 500 companies. And you can see that as we've been in the crisis between the first quarter, January through March of 2020, second quarter, going to the third quarter, earnings have been coming down. Now, the next three lines are forecasts. This is what the market expects Wall Street's expectation of the companies to earn. This first line, this kind of tannish line, reddish tannish line, basically represents what the market thought this year's earnings were going to be. And what you can see is they were a little bit ahead of what was reported. And then as we went into the crisis, much more pessimistic view, and then the earnings actually dropped to meet the pessimistic view. This blue line represents, for the same period, what the market expects the earnings to be next year, and 2021, and the year after that, 2022. So second forward year, first forward year. And so the point is that I'm valuing the companies not just based on what they're doing today, the poor expectations, but what I think they're going to do tomorrow, because a company's worth the sum of its future cash flows. So how does this get priced? Well, that's where we go to academically what we call the key value driver equation. And the idea is that a company is a perpetuity. And so since you're worth the sum of your future cash flows, perpetual long-term cash flows, we use this formula over here on the right to value a company. Now, I have another video that explains key value drivers if you'd like more information. But basically, this is the magic formula that determines share price. And there's four elements to it. Tell me what your expected profits are going to be. Tell me how fast those profits are going to grow over the long period of time. Tell me the return on the investment that you're going to get on those profits, and tell me the risk, or what's called the cost of capital, so I can discount those profits back to a current value. If I know those four values, I know the value of a company, and therefore, if I add them all up, the value of the index. One of the things that Wall Street is doing is they're forecasting profits. So on this screen, for the S&P 500, so again, for 500 companies aggregated, last year, they made $127.51 of actual earnings per share. So today, the market closed at 3380.35. If you divide the 3380 by the $127 of earnings, you get what's called the price to earnings multiple. So basically, they're trading at about 26.5 times earnings. Now, here's the thing. It's not just the last PE I look at. I care more about the forward earnings and therefore the forward PE. So next year, the earnings of the 500 companies are expected to be $164.40. They're going to grow 13% from this year. And the year after that, they're going to be $191.65. Now, those are estimates, but those are the estimates today. So for next year, 3380 divided by next year's earnings of 164 gives me a PE of 20.56. So said another way, the market is trading at 20.56 next year's earnings. So why am I trading at 20 times earnings? Right? Why am I not trading at 26 times earnings next year or 17? What's behind that? That is the key value drivers equation. That tells me how to price the companies. So let's do a little bit of math. First thing I need to know to price the S&P 500 is the expected profit. So next year, the expected profit is expected to be $164.40. So I'm going to go ahead and type that in. And then I need to know the book value of the equity to get a return on the equity. Well, basically the total investment, equity investment on a per share basis is $979.93. It's expected next year. $979.93, which means the expected return on equity next year is the $164 of earnings divided by the $979.93 of equity, or basically 16.8%. So the average company is going to make 16.8 cents a profit for every dollar of equity invested. Now, I need to know the risk. What is the risk level that the market's expecting? Because that's going to be the discount rate or hurdle rate that I'm going to adjust the earnings with. Right now, the cost of equity is, if I go back to Bloomberg, CRP. This is the equity expectations for countries. At the bottom is the United States. And today that number is 8.725%, which basically means on an annualized basis, Bloomberg is estimating, this is what the market's using, plus or minus a little bit, that the average company, as a return to shareholders, should generate about 8.7% per year in equity returns, given the risk that they're taking. That is a 0.642% risk-free rate, which is the yield on the 10-year Treasury, and an 8% risk premium for investing in equities. So about 8.7% is the expectation for the marketplace. So 8.725. Using the formula, and that would be this formula, that would say that you should get an S&P index of 1884 and a multiple of 11.5 with no growth. Now, what we're actually observing today is a multiple using that formula. I'm going to go back here to the screen of next year's earnings, which is 20.56. So why are we paying 20.56? And the answer is because the market expects growth. How much growth? Well, if it's 5% per year, we would trade at a multiple of 18.8. If it was 6% per year, we would trade at a multiple of 23.6. So somewhere around 5.4%, actually 5.5%, type correctly, 5.45, give or take, somewhere around 5.5%, actually closer to 5.45%, is the long-term growth rate on these earnings at this level of return and this level of risk that creates an S&P index of 3389. Now with rounding, again, the market today closed at 3380. So we're pretty close. That's the formula. And again, to get to that multiple. So these are what are called the drivers or key value drivers of what is driving share prices. And there are 4. Tell me what the profits are. Tell me what the growth rate is. Tell me what your expectation for return is. And tell me what the risk is. And I will price you. So why is the market trading at an all-time high given COVID-19? Well, here's the thing. A few months ago, the risk expectation was higher, probably closer to 9.5%. Well, here's the point. Share prices would trade at a multiple of 17 versus 21. Therefore, it's about a 20% discount on share prices if the risk expectation was higher. So let me translate. As interest rates have gone down, even though the earnings have gone down, because the expectations have gone down, lower interest rates, that has actually supported a higher multiple. Another thing that could happen is growth. There's an expectation that we're going to have a surge in the economy going forward and longer term growth. Let's say growth isn't as much as we expect. That could also drive share prices down a lot lower. So there's several factors that are affecting the marketplace. But basically what's causing the market to be higher, despite the challenges of COVID, are expectations for tremendous growth coming into the future and a lowering of the interest rates, which has kept the return expectations down. If any of those change, bad things can happen to the marketplace. But now you have a better understanding of what's driving the market.